Hello and welcome back to the Microlearning Institute. In this short tutorial we look at the essential principles of IFRS 8 operating segments. Many entities are diversified or multinational operations or both. Their products and services and/or the geographical areas in which they operate may differ in profitability, in future prospects, and also in risks. Consequently, segment information might be more relevant than consolidated or aggregated data for users in assessing risks and returns of a particular entity. The IFRS 8 standard applies to entities or groups with publicly traded debt or equity, or whose financial statements are filed with a regulatory organization. IFRS 8 requires disclosure of information about an entity's operating segments, its products and services, its geographical areas, and its major customers. This information assists users to evaluate the entity's business activities and the environment in which it operates. That assists users to better assess the prospects for future net cash inflows to the entity, which is useful in making decisions about providing resources to that entity. IFRS 8 adopts a management approach to identifying reportable segments. This means that an entity should report to shareholders using the same criteria it uses when it makes its decisions at board meetings. IFRS 8 defines the concept of a chief operating decision maker. This is not necessarily one manager with a specific title. It could be one person, for example, the chief executive officer, or alternatively, it could be a group of decision makers, for example, the board of directors. An operating segment is a component of an entity that engages in business activities from which it may earn revenues and incur expenses. An operating entity has operating results that are regularly reviewed by the entity's chief operating decision maker to make decisions about resources allocated to segments and the performance of those segments. And also, an operating segment has discrete financial information available for it. An entity must report segment information about each operating segment that has been identified as meeting the definition and also meets the 10% rule. The 10% rule: a segment meets the 10% rule if the segment total is 10% or more of the total entity's revenue, that's including internal and external revenue, or is 10% or more of the entity's reported profit or loss of all segments not reporting a loss, or is 10% or more of the entity's assets. The sum of the segments reported must constitute at least 75% of the operating revenue or profit of the entity. If the segment adds up to less than 75%, then more operating segments must be added even if they don't meet the 10% rule. Note also that IFRS 8 states that the cost of head office is not a segment. An entity must report information about the revenues derived from its products or services, about the countries in which it earns revenues and holds assets, and about major customers. An entity must reveal the operating segment profit or loss, the operating segment assets, the operating segment liabilities, if these liabilities are reviewed by the chief decision maker, and certain income and expense items if they are reviewed by the chief operating decision maker. An entity must also reveal how the segments were determined, the products and/or services provided by the segments, and any differences in measurement used in the segments versus those used in the financial statements. A reconciliation is required between segment totals and the totals revealed under IFRS. Here is an example of an IFRS 8 segment report for two segments, segment 1 and 2, for a variety of income statement line items, assets and liabilities. Thank you very much for joining the Microlearning Institute to review the fundamental principles of IFRS 8 operating segments.